Market rally? Is it sustainable or a precursor to a pullback? The stock market is roaring, with the S&P 500 rallying to highs we haven't seen in years. But here's the million-dollar question. Is this bull market built to last, or are we teetering on the edge of another major pullback? Imagine being on the brink of a historic financial shift and missing the signs. In this video, we'll dissect why the markets are surging, what's fueling investor optimism, and, most importantly, the risks hiding beneath the surface that could send everything crashing down. Before we dive into the details, let me hit you with this. Did you know that historically, December has been one of the strongest months for the stock market? But with inflation data, Federal Reserve decisions, and global geopolitical tensions all colliding, this December could break that trend, or amplify it. Stick with me as we peel back the layers of this market phenomenon. And hey, if you want to stay ahead of the curve in understanding market trends, hit that like button and subscribe for more in-depth analyses that can help you protect your portfolio. Now let's talk about what's driving this rally. At the heart of it is growing investor confidence in a Federal Reserve pivot. After months of aggressive rate hikes, the Fed has signaled that it may hold rates steady or even start cutting them in 2025. Lower rates mean cheaper borrowing, which is music to the ears of both businesses and consumers. But is this optimism premature? Inflation, while cooling, is still above the Fed's 2% target, and recent labor market data suggests the economy is far from slowing down. If inflation rebounds, the Fed could be forced to resume hikes, throwing cold water on this market rally. So are we running on real momentum, or just wishful thinking? Let me know in the comments what you think the Fed will do next. Meanwhile, big tech stocks, which have been leading the charge, are showing impressive gains. Giants like Apple, Microsoft, and Nvidia are surging on the back of AI-driven optimism and strong earnings reports. But here's where it gets tricky. These stocks now make up a disproportionate share of the S&P 500, creating a fragile foundation. If any of these companies stumble, it could drag the whole index down. Are we looking at the rise of another tech bubble? Stay tuned because we're just scratching the surface. Interruption time. Did you know that the 5 largest companies in the S&P 500 now account for over 25% of the index's total market cap? That's a concentration level we haven't seen since the dot-com bubble. If that doesn't make you rethink diversification, I don't know what will. If you're enjoying this analysis, don't forget to share this video with a friend who needs to know what's happening in the markets. Back to the rally. Another key factor is the strong labor market, which has boosted consumer spending. Retail sales data for November came in hotter than expected, signaling that shoppers aren't pulling back despite higher interest rates. But here's the flip side. Consumer credit is skyrocketing, with Americans now carrying record levels of debt. If the economy slows or interest rates stay high, this debt could become unsustainable, leading to a sharp decline in spending. And let's not forget about corporate earnings. While many companies have beaten expectations, profit margins are starting to shrink, especially in sectors like retail and manufacturing. If this trend continues, it could signal that businesses are struggling to pass on higher costs to consumers. Are we in the early stages of an earnings recession? Drop your thoughts in the comments because this is a debate worth having. Now let's zoom out and look at the global picture. Geopolitical tensions, particularly between the US and China, are casting a long shadow over the markets. Tariff talks, supply chain disruptions, and tech decoupling are all creating uncertainties that could ripple through the global economy. Meanwhile, Europe is grappling with its own set of challenges, from energy shortages to sluggish growth. These factors could easily derail the current market momentum. And let's not overlook emerging markets, which have been underperforming this year but could rebound if the dollar weakens. Are you positioning your portfolio to take advantage of these shifts, or are you too focused on US equities? Remember, diversification isn't just a buzzword, it's a survival strategy. If you're not sure how to navigate these waters, stick around because I've got tips that could save you a lot of headaches. Interruption time. Are you bullish or bearish on the markets right now? Let me know in the comments. And while you're at it, make sure to subscribe so you never miss an update on the stories shaping the financial world. Now let's address the elephant in the room, market risks. One of the biggest red flags is the bond market, which has been flashing recession warnings for months. The yield curve remains inverted, a historically reliable indicator of economic downturns. So why are stocks rallying in the face of this? Some analysts argue that investors are betting on a soft landing, where inflation comes down without triggering a recession. But soft landings are rare in economic history. Are we ignoring the signs, or is this time really different? Another risk is market complacency. The VIX, often referred to as the fear index, is sitting at multi-year lows, suggesting that investors are underestimating potential volatility. With so much optimism priced into the market, even a small negative surprise could trigger a sharp sell-off. Are you prepared for a potential correction? If not, it's time to reassess your portfolio. And let's not forget the role of retail investors who have been pouring money into the markets at record levels. Platforms like Robinhood have democratized investing, but they've also introduced new risks. The rise of meme stocks and speculative trading has created pockets of instability that could exacerbate a market downturn. Are we seeing a new wave of irrational exuberance, or is this the new normal for retail participation? Either way, it's a trend that can't be ignored. If you're a retail investor, how are you managing risk in this environment? Drop your strategies in the comments. I'd love to hear them. As we wrap up, let's take a step back and consider the bigger picture. This rally is a reminder of the market's resilience, but it's also a test of its foundations. Are we in the early stages of a new bull market, or is this just a bear market rally fueled by temporary factors? The answer will depend on a delicate balance of economic data, central bank policy, and global events. For now, the best thing you can do as an investor is to stay informed and adaptable. Diversify your portfolio, keep an eye on key indicators, and don't let FOMO drive your decisions. If you found this analysis valuable, don't forget to hit that like button and subscribe for more content that helps you navigate the complexities of the financial markets. Until next time, stay curious, stay critical, and keep questioning the narratives that shape our economy. And remember, the best investment you can make is in your own knowledge. See you in the next video.